Are you familiar with the acronym QSR? Well, if you aren't, maybe you should be. Indians have a unique relationship with food. The food market in India has grown steadily, and in 2018 it was valued at 3.7 trillion rupees, with almost 10% annual growth even since then. Casual dining restaurants and QSR or quick service restaurants account for more than 74% of the market and are growing exponentially. The term QSR or quick service restaurants literally denotes the future of Indian restaurants. Quick service restaurants are the chain models. Most of the restaurants are established where the footfalls are high, which is why you will find these places near the movie theatres or shopping malls. To reduce cooking time, most of the food items are prepared in central kitchens. The QSR segment is experiencing growth as a result of technological innovations as well, like improved point of sale systems, varied payment options, and improved geolocation to aid the delivery segment. The takeaway segment is expected to grow at almost 18% per annum, and the home delivery segment is expected to grow at 17% between 2022 and 2025. The QSR brands have been most commonly seen in mega and mini metros as far as the number of outlets go, with 50% of the total branches being centered around these areas. For the sake of growth, however, attempts have been made to make headway into Tier 1 cities over the last decade, with presence in smaller cities being seen only in more recent years. With increasing digitization and penetration of smartphones, the QSRs might have an easier time getting established in these new domains that they have set foot in. Rapid urbanization and employment opportunities resulting from it have also generated higher disposable incomes. As a result, people have become more open to spending on eating out rather than eating at home. Most importantly, what differentiates QSRs is the setup. Now, setting up a full service restaurant is time consuming and resource heavy. QSRs boast an asset-light business model compared to its full-fledged counterpart. It is also beneficial for the QSR that most are either self-servicing or takeaway, reducing the necessity for wait staff, allowing them to function well on a skeletal team just to run the kitchen. Now, over the years, there are several QSR stocks that have got listed and each has its unique positioning. You can see the basic financials of some of the top QSR stocks in India here. One such QSR stock that commands a significant premium over its peers is Jubilant FoodWorks. Jubilant FoodWorks, part of the Jubilant Bhatia Group, is one of India's largest food service companies. It holds the franchise rights for two international brands, Domino's Pizza and Dunkin' Donuts. The company also launched its first homegrown brand, Hong's Kitchen, in the Chinese cuisine segment. Now, when a business derives 56% of its revenues from 15% of its customers, it is clear that the business is heavily user dependent. So, what does the business do to retain high value customers without compromising on margins? It offers a loyalty program. The loyalty program can help retain these customers when competition is increasing amongst organized players. Plus, it can drive higher order frequency. Retention of these customers and higher order frequency may drive growth as well as profitability. Now, despite the incremental costs of loyalty program, the margins are retained and these costs replace some of the promotional expenses incurred in normal course. Secondly, the loyalty program is also likely to drive higher traffic to the business's app. The customer can receive loyalty points across platforms, but the rewards can only be redeemed through the company's app. Higher customer traffic in its own app can be a long-term competitive advantage. So, Jubilant FoodWorks launched a simple milestone-based loyalty program, Cheesy Rewards, in 2022. Hereby, customers could get a free pizza after every sixth eligible order. This was a well thought out post pandemic plan that allowed Jubilant FoodWorks, the owner of pizza brand Domino's, to bounce back from competition and inflation woes that had begun to threaten growth and profits. The loyalty program was very successful with enrollments crossing 10.6 million, and order contribution from them stood at nearly 40% by December 2022. Plus, as the cost of the loyalty program rewards were booked as discounts to customers, the program was not margin dilutive. Jubilant FoodWorks has the largest market share in the pizza segment and is one of the leading players in the food service industry. Since 1995, the company has exclusive rights with Domino's Pizza to develop, establish, own and operate restaurants in India. Plus, it now has franchises in Sri Lanka, Bangladesh and Nepal too. Jubilant FoodWorks also operates the Dunkin franchise in India since 2012 and has gained exclusive rights to develop, own and operate Popeyes restaurants in India, Nepal, Bhutan since 2022. The company has managed to sustain and grow through continued addition of stores and brand portfolio, increased customer preference, growth in online sales and menu innovation. Now, during the pandemic, the compulsion to stay indoors eventually accelerated the customer shift towards online food ordering. Most importantly, it made the non-homemade food much more acceptable outside special occasions, especially in smaller towns. Post-pandemic, the dine-in and on-premise consumption trends have certainly returned. But at the same time, delivery and takeaway channel adoption remain elevated. Secular trends of young population, rising urbanization, growing affluence, accelerated shifts towards digitalization, and shift in favor of the organized sector are the biggest catalysts favoring the business of Jubilant FoodWorks. Jubilant is also set for massive growth in physical and digital presence. Jubilant FoodWorks has cited plans to open 250 Domino's stores by the end of 2023. Its competition, Sapphire Foods and Devyani International, have also been aggressively opening Pizza Hut stores. Domino's is likely to open a greater number of stores as compared to Pizza Hut in India this year. At the same time, it plans to shrink the delivery radius and thus delivery time, putting stores as close as possible to as many customers as possible. Thus, Jubilant FoodWorks is well placed to stand out from the crowd in the intensively competitive food service industry. The technology investments of the company have also paid off. Domino's app has gained traction. The cumulative app downloads have increased by 4.4 times in the past 3 years. But there are also some concerns that one must keep in mind about Jubilant FoodWorks. Revenue concentration in Domino's. Domino's has contributed a major portion to Jubilant FoodWorks' revenue historically. The company intends to meaningfully transform into a multi-brand, multi-country food service entity. Multiple brand launches, Dunkin in 2012, Hong's Kitchen in 2019, Ekdum in 2020 and Popeyes in 2022 demonstrate that the company is trying to establish new growth vectors. While Domino's with 2,650 stores remains the flagship brand and growth driver, the company had a meaningful network of 83 stores of other brands in India by the end of 2022. There's also some execution risk. The management of Jubilant FoodWorks is focusing on growth in operations in Bangladesh and Sri Lanka, where it can leverage the Domino's brand. It also plans to scale up new brands such as Popeyes, for which Jubilant FoodWorks has the right to operate in India, Bangladesh, Nepal and Bhutan. Further, the management is repositioning the Dunkin brand with a coffee-first brand in line with the global positioning by its franchisor, Inspire Brands. As per Jubilant FoodWorks management, the company plans to expand its brand portfolio along with geographical diversification of its operations. This may expose the company to execution risks. Having said that, the company's experience of over 25 years of running quick service restaurant brands profitably while generating free cash flow offers some margin of safety. Important to note here that the debt to equity ratio of the company is at about 1.1 times, and this also remains a key execution risk for the company. Competitive pressures and raw material cost inflation. Jubilant FoodWorks witnessed intense pressure on operating margins in financial year 2022-23 due to the inflation in input costs. Thus, the business is exposed to competition from both organized and unorganized QSRs. While the company's scale, brand, and penetration level allow it to moderate price hikes and negotiate with suppliers over time, temporary margin pressures cannot be ruled out. Now, what is unique about Jubilant FoodWorks compared to its listed peers? The QSR business, as I said, is very competitive in India. There are several new stores opening and several others closing every day. But Jubilant has secured a niche position in the market. Currently, its competitors in the QSR segment are Westlife Development, McDonald's, Devyani International, KFC, Pizza Hut, Costa Coffee, Burger King, Subway, and others. Most of the other listed players have very little track record of consistent profitability like Jubilant FoodWorks. Jubilant FoodWorks has built such a successful franchisee model which wouldn't have been possible without a supply chain center. Jubilant has 8 supply chain centers. The supply chain centers have strict quality standards, and that's why the company's food items taste fresh and uniform. The stock of Jubilant FoodWorks has gained nearly 4 times in the past decade. The question is whether the stock can continue to create value despite the inflation concerns and stiff competition. Now, despite the post-pandemic business recovery, the stock of Jubilant FoodWorks has almost halved in the past 18 months. It is important to study the fundamentals and future prospects of the business carefully before taking a call on the valuations of the stock. Please note, this is not a view on the stock. Please do your due diligence carefully and consult your investment advisor before allocating to any QSR stock. Hope you like this video. Thanks for watching.